But I think it gets really interesting when you can put, both fiat currencies, or multiple fiat currencies on a blockchain with the right level of liquidity, where you move, payments fully on chain and can do on chain FX, and you can do kind of an execution through a DEX or something like that. So I think I'm excited to see if we head that direction. But today, I'm seeing it super early days, and I guess my view for 25, 26 is still overwhelmingly dollar denominated.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name's Simon Taylor. I am your host for today, author at Fintech Brain Food and head of strategy at Sardine. And joining me is my co-host, my friend, Cuy Sheffield, head of crypto over at Visa. Cuy, how are you? What excited you this week?
I'm busy. I'm just trying to survive. I think we are at a very exciting time for the industry, but also a much more stressful time with the amount of interest and demand on this topic that we cover.
It's a high quality problem. If there's a weather vane for demand for stablecoins, I think Mr. Cuy Sheffield from TradFi especially has probably got a front row seat to that. Well, you didn't ask me, Cuy, but the thing that excited me is the fact that Tokenized now has a newsletter. So if you go to tokenizedpod.com/newsletter, you can find it there. So go ahead and subscribe. That would help us out a bunch. Joining Cuy and myself today is Chris. I still don't know how to say your last name, Chris. Chief Business Officer and co-founder of BVNK, our second only returning guest. So you're doing well here, Chris. How are you?
I am doing great, Simon. I mean, look, I'm truly honored to be back on for the second time, because the quality of the guests that you've had on in the last 6 months have been right up there. So really excited to be chatting with you guys today.
Well, speaking of quality guests, we have Nabil Manji, who's SVP and head of Fintech growth and financial partnerships at Worldpay. Nabil, how are you doing, sir?
Yeah, I'm good. Thanks, Simon. Thanks for having me. Excited to be here. Hopefully, you guys are happy with me by the end of the podcast, so I can maybe be a returning guest too. So I guess that'll be...
I mean, it's all to play for. It's all to play for at this point. Just follow Chris's lead. I'm sure you'll be fine. Before we continue, I do need to remind our viewers and listeners that views and opinions of contributors are their own and might not reflect the companies they're representing. So please don't take anything we say as tax, financial, investment, or legal advice. Do your own research. Be safe out there, folks. All right, first story this week from everywhere. The Wyoming state is gearing towards launching a stablecoin. This will be the first fiat-backed token issued by a public entity in the United States. The Wyoming stable token, WYST, is currently being tested on multiple blockchains in collaboration with Layer Zero, which, if you want to know who Layer Zero is, we had their co-founder Brian on just 2 episodes ago. So you can learn more about Layer Zero. This is a huge headline, but Chris, why would a state want to issue a stable coin, and how might something like this actually work?
I mean, I was quite surprised at the headline, to be honest. I first thought, they're going to be giving state-level tax discounts if you buy the local stable coin or something like that. But look, no, all jokes aside, I think it's just this existing trend that we're seeing all around the industry, where with that regulatory clarity through things like the Genius Bill and OCC allowing banks to hold stable coins on their balance sheets, it looks like the states want to get involved as well. So, look, I think it's all part of the same theme. More clearer regulation allows more innovation at in different pockets of the industry, and it was a little bit light for me on what exactly the use cases and they're going to do. So it felt a bit fluffy, but let's see. Maybe they are going to give state level tax discounts if you buy the stablecoin.
Well, Cuy, what are your thoughts here? And without getting into the speculation of what it could be for, I'm curious as to the signaling and what you think this means for the broader industry about stablecoins.
Yeah, so I think first important to recognize, it's not out of nowhere for Wyoming. Like if any state were to do it, Wyoming would be the state. And it seems like, they've taken a very kind of pro crypto regulatory stance for a number of years now. And I know Caitlin Long and others have done a lot of work, really advocating for crypto and stablecoins. I think, it does speak to Chris's point of, as there's regulatory clarity for stablecoins, and there's a pretty clear aspect of how to issue them, I think we're just going to see more and more of these, issued, and there will be many different types of entities who try and issue them. And I think I've heard or seen in the past that there was a notion of, using the interest income generated by the stablecoin to fund, certain initiatives, in the state. I don't know if it was like the education system or other aspects. And so, I think it's an interesting concept. Like, is there a demand of a Wyoming consumer who says, you know what, like, I want to support my state, and so I'm going to hold Wyoming stablecoins because, the interest income is going to, stay here at home and, go right back to the state. Like, I think we'll see a number of experiments, and it's hard to imagine that someone outside the United States, would choose the Wyoming state, stablecoin over, any other, global stablecoin that exists today. But I think we'll just see more efforts around how do you use the economics that stablecoins generate, to fund, different, elements in from the issuer.
Yeah, I wonder about the optics of moving from what was a conversation around central bank digital currencies towards state level issuance of stablecoins. And really the question of what's backing it and what's the technology have been bifurcated. The technology is typically something that looks and feels like a stablecoin. The question of what's the credit risk and who's backing it is really what we're seeing a Cambrian explosion in at the moment of kind of states and lots of different companies all sort of getting involved. Nabil, what are your thoughts on the regulatory clarity and the thoughts generally of some of the use cases that you're seeing with stablecoins and where this may or may not fit within that?
Yeah, so I kind of love this story because in some ways it's not new. Like Wyoming passed the legislation to, develop a state stablecoin, I think in 2022, and then had the working group set up in 2023. And now, 18 months later, give or take, they're kind of saying we're getting close to launch. And I think the timing is perfect. And I think to Kai's point, some of the use cases are around better funding of state programs, whether it's education or other. They've said that publicly. They also talk about how they're quite bullish on DeFi and other uses of, let's call it, more highly regulated or more highly trusted stablecoins, and they want to be at the forefront of that. So they kind of think, hey, if stablecoins are going to be used in a big way for different financial services and products in the future, what better way to potentially be a winner in that ecosystem than having the backing and trust of a state government, which, to your point, Simon, in the intro, they're the first kind of major public entity in the Western world to issue something like this. So I think they're trying to angle for some of that winning. And if they can do well, that potentially is a windfall for the state. So I think it's really cool because of that element of, there being a state actor backing the currency, or at least the framework around the currency. And it's been really interesting, I think, in the evolution of stablecoins. First we had Tether, which didn't really have a nexus to a lot of the Western or developed world. And then you had Circle, which did, and then you've had major traditional financial institutions issue stablecoins. And then now you have a Western government agency issuing stablecoins. So we're kind of like on that curve of adoption and legitimacy, clarity, transparency, trust, whatever terms you want to use. To me, this is just like another stepping stone or another block on that journey, and a really nice validation, I think, of the space.
Yeah, I think it's fascinating that the decentralized model of the US means you get this experimentation at different state levels, and you can kind of see what works before you roll it out at the federal level, and kind of take it from there. People forget.
I kind of want to know, actually, one thing to add, just as an aside. This is a bit nerdy US stuff, but a lot of times in the US, if you buy municipal or state bonds, the interest those bonds pay is tax-free. And so I'm like, could I go get some, Wyoming stablecoin and start yield farming and not pay taxes on that yield? Because that could be also really quite interesting. But I think that's probably uncharted territory. but we'll see.
Well, there does appear to be more open competition now, right? So Wyoming is definitely competing with Delaware for being one of the capitals to incorporate companies in, as is Nevada, as are many others. So there's a question there about consumer protections and fraud and anti-money laundering, and I think there are lots of serious things to think about when you move in this direction. But experimentation and sort of slowly getting there is eminently sensible. Chris, I want to zoom out for a second and talk about kind of your perspective on that increasing clarity. What are you seeing in terms of the conversations you're having as headlines like this hit? Is this all hype, or are you actually seeing it on the biz dev side as well, that like there's meaningful action?
No, we've seen an significant increase in either conversations we were having at, we definitely have a focus on kind of like the enterprise PSP and Fintech segment. And 2 years ago, you were having very early conversations with innovators, post Q4 last year. Those conversations have increased. And then fast forward to today with headlines like this and the Genius Bill coming through and these sorts of things, it's people are now ready to move. It's not just, hey, this is cool. Let me, can you chat with me about a few use cases we could one day, hopefully, eventually implement. It's okay, there's an RFI out. You're in the RFI. What can you do? These are the technical specifications. We want to do and enable XYZ use case. So, and that's broad strokes. That's enterprise PSPs, that's fintech platforms, that's marketplaces. So no, it's, we've definitely seen the pipe build and are quite excited about, 2025 and what, what will come from that, and the conversion of that interest into actual business.
Yeah, I think we've talked about it on the show before of like issuing a stablecoin is relatively easy. Getting distribution and adoption is pretty hard. And I think a lot of people are going to realize that. And I think you'll see a lot of interest in, okay, now that there's a framework, like let's issue a coin and like see what happens. And I can see a world where a few years from now, there's this like on-chain graveyard littered with like attempts of stablecoins. Many companies like, it sounded attractive of, oh, let's issue one like we can. But then, how many of them have a clear plan and get distribution? Like, are people going to come directly to them? If you don't have a core business, how do you get someone to choose you? I think those are becoming the really hard parts rather than just, oh, like, yeah, you can issue a stablecoin, but does it actually make sense?
Yeah, it was reminiscent almost of the wildcat banking era of the railroad boom in the late 1800s, where any bank could create their own dollars and issue them and sort of then also lend anything it wanted. And there was just endless boom and bust cycles as credit creation went wild, but so did the boom and bust cycle. And that's when the OCC actually came in and started mandating control over the creation of the currency. The Office of the Comptroller of the Currency comes from that historical quirk. And to your point, it does appear like the Oprah meme of you get a stable coin and you get a stable coin is absolutely happening, because our next story is, this was covered in the Financial Times, but this was about Fidelity, the $4.9 trillion of asset under management asset manager, is going to launch its own stablecoin. And they're apparently in the advanced stages of testing. And this is just a week after they announced the filing with the SEC to launch a tokenized treasury fund. So is there rationale here, Chris, that you can see for somebody like a Fidelity to be launching a stablecoin and tokenized treasuries together? Is what would you see as kind of the use case here? And are there some upsides of issuing your own stablecoin?
Yeah, I think the firstly, it really is one thing. It's adding like CeFi credibility and DeFi efficiency kind of like together. So, and when we talk about the DeFi efficiency piece, some of the older treasury, treasury funds that have been issued, they're still struggling with that interoperability back into fiat. And, we've spoken to a bunch of these issuers, and you might get same day and instant settlement, or redemptions of that, but to actually mint something like a BUIDL is quite a process. You send dollars to a bank account that, then you need to buy stable, then you need to mint the treasury, and then if you want to sell it, it can go back into stablecoin. So I think despite the treasury product being put on chain, the settlement capability with stablecoins was still lacking and therefore left, some efficiency gains to be desired. by doing this and issuing a stablecoin and the treasury, you can now settle that treasury in stablecoins for the mint and the burn. So I think it's really almost like a full stack approach to stablecoins on the settlement payment infrastructure side, plus the capital markets. So it's kind of bringing the capital markets efficiency of DeFi plus the payments efficiency of stablecoins, to bear. And I think with a $4.5 trillion asset manager, as you mentioned, it really is adding that CeFi credibility element to it. So that's kind of
Do you know, just to give that some context, good friend of the show and sponsor over at Digital Asset, Yuval Ruse, had a great framework for thinking about stable coins as your current account and treasuries as your yield account. And it's amazing to be able to move between those and to be able to do so in real time. But if the practical reality of a BUIDL token is that you can't move between those in real time, then it sort of breaks. So it's quite a competitive move to do something different. Cuy, you were about to jump in before
Nabil, I'd love your take on, like, I feel like there's this world of like vertical integration of the same companies offering tokenized treasuries and stablecoins. You know, you had BlackRock with BUIDL that then partnered with Circle, so you could do USDC to BUIDL, and then Circle acquires Hashnote, and so that now they've got USDC and USDY. Like, how do you see, Nabil, like this intersection of like the tokenized treasury and the stablecoins coming together?
So I think Chris hit the nail on the head where, it's not just tokenized treasury, right? It's really any tokenized asset. There's a lot of reasons to do that, but one of them is for the speed and availability in terms of trading and moving that asset. And of course, when people are trading tokenized assets, one of the other assets they want to go to and from or in between is dollars or their local fiat currency. But that leg of the transaction in many cases has been missing. As you had these, let's call it non-fiat or non-dollar assets that were tokenized and could be moved and traded 24/7, 365 nearly instantly, but only if you wanted to go between those assets, not back into your local currency or into fiat, which many of us, myself included, when I'm trading, I'm more often than not trading back into fiat before I want to decide what I want to do next with that fiat. I'm not going from one asset straight to the other. And so I think it was kind of like a natural expected evolution to have that real-time fiat in-out capability for those tokenized assets. And I think what's interesting, particularly with some of these large asset managers, is they have such large portfolios, such large customer bases that, as we spoke about 10, 15 minutes ago, we're going to have a stablecoin for you, like everywhere, right? But these asset managers actually have, I think, a built-in kind of distribution and network advantage. And so they're kind of seeing the monetization of that where, I don't know what Fidelity's plans are, but let's say when they launch it in the near future, if it has to be used to go in and out of some of their tokenized assets or treasuries or money market funds or whatever it is, they're going to immediately have one of the largest market cap stablecoins out there because people are going to want to access those products and they're going to control the way that those products get access, which is through their new stablecoin. And so that just increases, I think, the business case for them and the economics of the ecosystem for them and their customers.
Yeah, I think it's an important point of clarity. This is Fidelity Digital Assets, a separate operating unit of Fidelity that's doing this. And Fidelity Digital Asset has been, kind of an innovator in this space for quite some time. They're very, very different organization to some of their competitors. Still very much family owned. They've been offering, Bitcoin in the portfolio with an integration with Coinbase, I think, as early as the mid 2010s, and they've been progressively pushing down this path. So it's not a shock to see them innovating. I think what is interesting is, to your point, would they push this into their broader book, and would we see others do it? And I think that's kind of my big open question. Cuy, you sort of made a point of, will we see a graveyard of stables, or will the letters start to disappear? Because it's getting incredibly complex dealing with the alphabet soup of stablecoins. and I'm just interested in what you're seeing kind of evolving in that space. Are we just going to end up with a world that's actually worse than fiat? Because I don't have to think about what flavor of dollar I want to send you.
We're running out of letters, and now they're numbers. I thought I saw USD1, like, is it going to be USD2? Like, how many are we going to go to? I think there's a huge branding problem and challenge. Like, I think it's going to be really hard for consumers to distinguish. Like, my like framework is, if you're on an existing platform and you've got a relationship, with a brand, so if you're on Fidelity, if you're holding funds on Fidelity, like, I don't think you really care. You see a USD balance on Fidelity, having that be a Fidelity stablecoin on the back end, it's USD on Fidelity. So I think you'll see like the brand of the stablecoin, fade more into the background, and it'll just be whatever brand of the app, that you're interacting with. I could see that world. I think it's going to be very difficult if you're like in a self-custodial wallet, or you're on a DeFi protocol, or you're on a place where like there isn't a default brand behind the scenes, and then now you're exposed to selecting a brand, and then how do you make that selection? Are you going to go and look and read the terms and disclosures of like compare one to the other? I tend to have a preference for like, if the brand starts with USD, I think that's more compelling than like if the brand starts with other letters and then like has USD later. So it's a really weird space that I have a hard time imagining a few years from now, consumers particularly are going to get accustomed to having this like really direct brand association with all these other letters in the alphabet soup that you mentioned.
What about you, Nabil, from a merchant perspective? Are they kind of dealing with a similar cognitive dissonance? Because I know the treasury benefits of B2B payments and cross-border settlement are an area that merchants really, really care about. But are they willing to adopt new technology to do that, or do they need us to hide the wires as well?
I think you've got a mix of both. So I think particularly over the last 2 years, we've seen some of our more, let's say, technology forward or more innovative clients actually starting to do this themselves. So there's a number of clients that have actually been working with the Connexus offering from JP Morgan to more efficiently manage their corporate treasury, particularly for businesses that have, very distributed geographic footprint and need to move liquidity around those entities, whether it's for things like payroll, vendor payments, normal operations, whatever. So I think you have seen quite a few of the, I would say, more innovative companies move that direction. But I think for others, not everybody's a giant merchant that has 1,000-person payments team and can assign 5 or 10, 20 people to figure this out and execute it, right? The others, let's say, are going to rely on companies like Worldpay, like BVNK, and others to quote unquote hide the wires and deliver not a stablecoin solution, but just a solution for more efficient treasury management. And it goes to Cuy's point around abstracting away the branding of the assets behind or the branding of the technology behind. It just is like, hey, this is our new 2025 corporate cross-border liquidity and money movement solution, and here are the benefits vis-a-vis what you might be using. They don't
It
really
just happens to be 24/7. It happens to be instant, and it happens to be you can switch it in and out of a money market fund instantly. I want
And
that.
the funny thing about the whole stablecoin branding thing is, at a very basic level, a stable coin is just a right on an asset that is sitting somewhere else and or being custodied by another party. But think about when you have money in an e-wallet, it's basically the same thing. Like you have the right to withdraw dollars or euros or pounds or whatever your balance is in the e-wallet. But not every e-wallet is branding your fiat balance as like, you know, name of company, then currency, or currency, then name of company. It's just your euro or dollar or GBP balance in that wallet. And for me, like, yes, maybe the slight nuance here is that, with an e-money institution, your dollars or euros or GBP are either in cash or like very, very liquid, low risk instruments. But that's not like that different than a stable coin, right? Like when you have a stable coin, it's backed by a basket of assets, most of which are very liquid, very low risk, a lot of which is in cash, and you have the right to, redeem or mint on demand, which is basically a demand deposit, which is just what we call fiat in a bank account. So yeah, I kind of agree with Cuy. Like, I don't know why branding here has taken off so much. Maybe it's just because it was a new industry. We needed to brand the different players, stuff like that. But I think as you get them more embedded in traditional financial services, whether it's investment platforms, whether it's e-wallets or whatever, I've got to imagine that some of that fades into the background and is maybe like a note in the T&Cs or like a footnote at the bottom of the web page.
Yeah, I see it from the issuer's perspective. Like it carries their brand for a little while.
Yeah.
What do you think, Chris? Is that an inevitability? Is it starting to happen? Or are you still in the midst of adding new stable coins every week to BVNK to support as much as possible?
No, I mean, I think, very much you've seen, as you guys have said, the 200 plus stable coins that have popped up. And I think we've been in the space for quite some time, and we're really in that kind of distribution layer where, the whole point of the stack that we run and the product that we have is to abstract that complexity away. And it's really just like dollars running on a blockchain, paying someone else. And you get, as we've spoken, you get personal preference today in terms of a specific brand of stablecoin. Maybe there's some regional preferences. And then you've seen big payment companies like PYUSD launch theirs and try to add their brand credibility to it. But for us, the whole ethos of is really multi-rail, i.e. multi-blockchain, multi-stablecoin, and then abstracts that, choice. So when we do something like the stablecoin sandwich, going fiat, stablecoin, fiat, the system is really just looking for the cheapest blockchain and the best stablecoin to do that payment and, deliver it on the other end versus trying to pick a specific branded stablecoin. So today we support most of the major ones. We'll probably have to add a few on merchant demand or client request, but I think long term it probably settles somewhere around and starts becoming more of a unified space instead of this specific brands running at the problem.
Yeah, because I can see different stable coins having different benefits with different merchants or states or whatever. Like the Wyoming token, your tax is automatically calculated, so you get discounts at certain places, and like the blurred line with loyalty and stable coins becomes interesting. But to your point, really this is a UX problem more so than an infrastructure problem, because you can abstract this pain with BVNK, with Zero Hash, with Bridge and others, but you can't necessarily solve the consumer experience problem or the business experience problem, especially if they're used to seeing that thing. But maybe you should. I mean, Sling Money comes along and just displays fiat and it doesn't display the other things. Cuy, are you seeing, like, in the dollar cards world that they're still displaying the nature of the stable coin? Or because you said a couple of weeks ago that in many markets they want dollar cards now, and just unpack that a little bit for me on what you're starting to see.
Yeah, I think it depends on the app. We are seeing, I did notice that particularly in Latin America, some of the dollar focused savings accounts, particularly that use USDT, the T is lowercase, so it's USDT. It's like there's like slight like branding that's like getting a little bit closer. So the question is, does it go from like lowercase t to then eventually just USD? And I don't think that consumers, particularly once you get regulatory clarity, like there's an argument that the brand is really important and matters a lot in a more Wild West frontier market where different stablecoins, are regulated in different ways with different reserve requirements. If you truly get some harmonization of, if you're calling something a stablecoin, and it's offered in a certain market, it's got to have some kind of floor of what the reserve requirements are. Then I think you could start take that next step, and instead of you remove the lowercase and you just say USD. So we're not there yet, but I think that's the likely direction that it's heading.
Fascinating to watch. Final question, just for the bunch of you, which is before we move to the ad break. Do we see other G7 currencies start to emerge as stablecoins, and is that ever happening, or is it still the dollar card? I mean, Nabil, Chris, what are you seeing in your networks? Is there anything starting to happen in that space, or is it still wildly dollar dominated?
I mean, we us being a multi-stablecoin platform, we're still seeing we see kind of demand mimic market cap, 99% USD stablecoins, but that's obviously changing. There's AED stablecoins, there's an SGD one, there's an IDR one. So there's EM ones popping up, there's G7 ones, as you were saying, popping up. I think it comes back to the liquidity, liquidity distribution sort of problem that you start when you issue a new stablecoin. But I think it gets really interesting when you can put, both fiat currencies, or multiple fiat currencies on a blockchain with the right level of liquidity, where you move, payments fully on-chain and can do on-chain FX, and you can do kind of an execution through a DEX or something like that. So I think I'm excited to see if we head that direction. But today, I'm seeing it super early days, and I guess my view for 25, 26 is still overwhelmingly dollar denominated.
Overwhelmingly dollar denominated. Well, on that note, we will thank our sponsors and we'll be right back. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. Tokenized is also brought to you by Avalanche. Major banks, fintech challengers, and industry leaders are using Avalanche to create new business models on a fully customizable blockchain infrastructure. Think of it as more than a blockchain. Think of it as an entire network built for financial institutions to innovate. With purpose-built layer ones, institutions can tailor digital asset strategies to their exact needs while still tapping into the power of a public blockchain, innovation, developer communities, and seamless interoperability. Join the institutions shaping the future of finance on Avalanche, and you can learn more at avax.network. All right, the next story we picked up from the block. This was about Athena and Securitize launching a new institutional-grade EVM, so Ethereum-compatible, chain for tokenized assets. The new chain aims to make DeFi more accessible to institutions by providing compliant settlement and custodial services kind of out of the box. The public network will integrate a native Know Your Customer KYC wrapper and provide access to Athena and Securitize's whitelisted investment products. So public chain, but whitelisted with KYC baked in. It's really, really fascinating. So I'm interested in sort of the attraction to something like this. Chris, Cuy, Nabil, any of you wants to jump in? Do people want this like sanitized EVM chain? What are your thoughts on like institutional change generally, Cuy?
Yeah, so I want to hear what Chris and Nabil think about this. Like the way that I would frame it is, this is actually one of the more interesting areas of debate in the space right now, and I don't know which direction it's going to go. But I'd frame it as follows: it's like, as institutions come into the space, as there's regulatory clarity, as more and more institutional use cases get built up, there is the question of, okay, will the existing blockchains that have really dominated the crypto use cases, have played a role in the fintech use cases, be the same blockchains that satisfy all the requirements and properties that you need to scale institutional use cases? And if you talk to Solana, the Solana Foundation and teams, they'd say yes, like absolutely, like we're ready to scale the institutions. And then there's a new class of competitors that are basically saying, wait a minute, what about embedding KYC? What about privacy? What about these things that we know institutions care about, that when you're a chain that's supporting meme coins or supporting many different use cases, it's very hard to optimize for that. And so I have no idea, if you ask me kind of which side is going to win 5 years from now, and probably it's some combination of both. But Chris, how do you think about, like, is there enough of a demand and need, maybe even just in a payment context? Will there be institutional payment chains, or is it just going to be Solana-based, the chains that exist right now that institutions get comfortable coming into?
Yeah, I mean, it's definitely an interesting topic. I mean, firstly, I do like the name Converge, and I'm kind of converging of these two systems, and the fiat and TradFi, or TradFi and crypto. But the way I think about those institutional chains, I mean, you're seeing some purposeful stablecoin payments chains pop up, and what they do is, they, instead of paying gas in the native token, they pay gas in stablecoin. So I think you're seeing, it's the early innings in trying to understand, as you said, can the chains of yesteryear support the future regulated use cases that are coming to market, specifically in a payments context? And then if not, what does a KYC'd institutional grade payments chain look like, and what features does it need to have? So I think I agree with you. It's quite early days. I'm not sure where it settles, but I think, these are the early moves. There's a small startup out of Singapore called Codex. They're building a specific, specific also EVM based chain that's hyper optimized for stablecoins and cross-border payments. And like I said, they've actually changed it. Instead of paying in the native asset, you're paying gas fees in stablecoins, which makes it a little bit easier to operate and do payments with. And then you're seeing things like this, bringing institutional grade infrastructure, and really trying to hyper optimize the chain for KYC, KYB led TradFi products, which I guess they're, modules, or what are you going to call them? Kind of like modules you can build into the traditional kind of chains to achieve this. But when it's natively, in the kind of core infrastructure, it probably gives you a bit more flexibility. But yeah, I'm not sure where it settles. I'm sure there's going to be a lot more of these pop up, given what we've seen so far in the last 6 months. But let's see where it settles. But
Nabil, what are your thoughts?
Yeah, so for me, this is actually super interesting because of a couple reasons. One is because we talk about stable coins and blockchain-based payments. One of the things, or really like the main talking points or benefits that are typically touted are speed and cost efficiency. There's a longer list, but I think those are the two ones that get discussed most. And the thing I always like to say, which I'll repeat here because I like to say it, is, moving money around the world is really just moving ones and zeros, like moving any other sort of data, whether it's an email or a text message. And we as humans have had the technology to move ones and zeros around the world instantly and very cheaply for a long time. Think about how much you pay for a text message or an iMessage or whatever, right? So for me, like the complexity and the cost of payments isn't necessarily driven by technology disadvantages. A lot of it's driven by what is the other information or other requirements that need to be met, or information that needs to be set with a payment, and or other requirements, whether regulatory or otherwise, that need to be met before you make the payment or receive the payment or whatever. And so that's what drives the cost, setting aside FX. And what's interesting here is, we haven't really solved that at scale in the blockchain space. So like, yes, you can send a stable coin across the world nearly instantly and very cheaply, but you need to think about things like travel rule and wire fund transfer regulations and things like that. And that hasn't been solved at scale like it has to some degree in the fiat world. And so this whole concept of like embedding things like KYC in the basic technology layer, like the blockchain that's being used for that payment, is super interesting because it almost like extracts that away for the like whole ecosystem on that chain. And the way I kind of think about it, like the parallel to the fiat world is, in most of the Western world today, if you want to sign up for a financial service or product, you have to go through KYC with that provider. Maybe it's a bank, maybe it's an e-wallet, maybe it's a payments company, whatever. But each time you sign up for a new financial service in your own country in the Western world, you're going to go through like a different KYC experience, and that company, or in this language, application, is not going to provide you that service until you go through it. But then you go look at a company or a country like India, where they've issued their new digital ID, and a lot of regulated service providers there are being mandated to accept that digital ID. And so basically they're transitioning from this concept of like each application or each company needs to do KYC to having like a base KYC level layer or ID layer for everybody in the country. And so now you show up at a financial service provider or other regulated business and you present them your digital ID on your phone. And if you have that, there is no KYC. Like you just prove that you've gone through that base level governance process, and that's your valid credential. And so like now if you're running a KYC company in India, your business model is like, it's not there because it's not needed anymore. And so for me, this is kind of like taking that concept and putting it on chain.
It's interesting. There's been so many decentralized identity startups around crypto generally. And there's, Canton would tell you they do a lot of work on privacy inside of their network and connectivity. The idea of baking it into the chain is like one more feature that you could bake into the chain. And I guess where I stand is I'm unclear as to which is the better answer. But Nabil, I absolutely agree with you. All of the cost in payments is risk. It's related to identity. It's related to refunds. It's the what happens when something goes wrong set of questions, and who makes you whole when something did go wrong, and how do they make you whole? Like, this is why I wrote a piece a few months ago called "Stablecoins aren't necessarily cheaper, but they are better because you typically can share more data about the payment, kind of around that." Cuy, your thoughts?
Yeah. I think maybe the other reason that this is such a hot topic is we're seeing that everyone sees how valuable layer one blockchains have become, and if you can become a dominant blockchain that builds a real network effect with wallets and exchanges, they have accrued a good amount of value in terms of the market caps. It feels like in crypto, if you're competing for crypto trading, meme coins, like it's a much more mature market where it's hard to compete against Base, against Solana. Like those networks are really growing and scaling. The new area that's not as mature is institutional use cases, and so there's a shot that someone could come in and say, hey, not every institution has come on chain yet, and so maybe they'll come onto my chain instead of coming onto an existing chain. And so kind of the summary as I listen to you, it's super helpful framing. It feels like there are really like three requirements that people are focused on that most institutions would agree that they need that blockchains have not fully solved today. The first being embedded KYC or some type of identity layer, which I think you'll see the existing chains try and support and add. And Coinbase doing some really interesting things with Coinbase verifications on Base, but like that hasn't really been solved. The second is gas fees and stablecoins, and it is still kind of baffling that you got to convince an institution to go and buy Sol or buy ETH to then be able to launch a stablecoin or transact with a stablecoin on Ethereum or Solana. And so, like, is that going to change? And like, are they going to enable gas to be paid on those chains, or do you need a new chain? And then privacy, being the huge one, which I don't think gets nearly enough attention. And my bet is that I think we're going to see a lot of these use cases start to scale, and as they scale in terms of stablecoin payments, people are going to start to realize how much of a lack of privacy there is and how much there needs to be privacy. And then there's going to be a rush around, okay, how do you embed privacy around existing chains, or do you build new chains of privacy? And then you have, okay, how do you still have compliance but privacy? And so I think it's still very much an early, wide open area. And I'm excited to see more innovation and competition and different companies trying to come in and solve this for institutions.
And to that point, when Coinbase launched Base, there was quite a bit of cynicism about whether that was going to make a difference. Optimism and Arbitrum were already established, and Ethereum was established, and Solana. What did this centralized exchange have any business doing launching its own chain? And actually, when you look back at it, it's been wildly successful. So one might argue we are still very much in the early innings, and it's all to play for. And if you do succeed, it can be quite lucrative. Chances are you won't. And there's a graveyard of a lot of these things, but that's why they call it a risk. Any thoughts on Athena itself and USDE? Because producer Petrit, shout out, put some notes in the show notes, which I hadn't really looked at USDE before, and I didn't realize it became the fastest USD crypto asset to hit a $3 billion market cap in history. And it's backed by a delta neutral ETH position. So in plain English, it's collateralized by long staked ETH and simultaneously offset with a short perpetual futures contract in ETH. So ETH long staked, perp future short keeps the dollar peg. I mean, it's experimentation. There's I really don't know. I mean, I know delta neutral positions quite well, and they have existed, but I feel like I need to go talk to Luca Prosperi about this and read Dirt Roads to kind of get an understanding of it. But Chris, Nabil, any thoughts on USDE itself and the growth you're seeing in that space?
I think it was a perfectly timed product for some DeFi degens that were finding it quite difficult to kind of execute these trades themselves on platform. And the team at Athena did a great job by taking, you get like a double whammy on the yield. You effectively get the staked ETH yield, and then you get the yield generated, through the ETH futures, through the ETH futures mechanism that you just explained. But, is it the kind of, when we've looked at it, we've stayed quite far away from any algorithmic type, anything that requires, that's non, fiat backed stable coins, at least for the payment side of things. And that's like quite deliberate because it's experimentation. It's been wildly successful. As you said, first stable coin to 3 billion. But yeah, I think from a payments perspective, we've stayed a bit away from it for sure.
But to their credit, they're not calling it a stable coin now. And I think it also is important to say, like, it is a tokenized, financial product, but because there's not fiat behind the scenes, I think it's just something different than a stable coin backed by fiat. But Nabil, good.
I was going to say there was another non-fiat backed stablecoin that offered promisingly high yields.
Terra something and something with a moon, Luna. Yeah, I see.
But yeah, I think to Kuy's point, stablecoin is probably the wrong term for USDE. And if we all believe in the efficient market hypothesis, the level of reward something generates should match the risk. And the reward is materially higher for USDE than it is for other quote unquote stable coins. So to me, that suggests that there is a level of risk that is, go ahead.
I like that bifurcation because under the current draft of the Genius Act, this would not qualify as a stable coin. And I think that's going to be helpful framing going forward, that there are assets that try to closely track the dollar with higher yield, but those receipts for that position that you can trade as a token and use as a token aren't necessarily guaranteed to be stable or don't have the same risk profile. I think that's such a great point. So final story this week is, it's M&A season. Coinbase and Kraken have neared records with their crypto acquisition. So Coinbase is reported to be nearing the acquisition of crypto derivatives exchange Deribit, which would value it in the region of between $4 and $5 billion. And of course, crypto exchange Kraken are rumored to be interested in acquiring them too, but have instead acquired NinjaTrader, which means Kraken can now offer crypto futures and derivatives in markets in the US, adding to their existing UK and EU and Australia licenses. And NinjaTrader has close to about 2 million customers. So lots of M&A in the space. Do you think that we're seeing the convergence? Converge seems to be the theme here of like finance and trading and crypto. Is this like DeFi efficiency on sort of the new exchanges world? Does everybody need to be in one of these spaces? Any thoughts?
I think a couple things. So there's no doubt that, let's call it, investment platforms for traditional financial assets and digital assets are converging, right? Many of the US investment platforms, most famously or notably Robinhood, started to offer crypto trading years ago. And similarly, a lot of crypto exchanges have started offering stock trading or ETF trading or other traditional financial service products. And to me, this is just the next iteration or another extension of that. And I think part of it too is, as the market becomes more regulated, more liquid, you're going to see those nice spreads, the trading fees that the exchanges have enjoyed, I think, get competed down as they already have been over the last 5 years. And so I think part of it is then thinking about what are the other products and services I can bring into my portfolio that I can continue to extract, a higher margin on as those traditional trading fees get competed away. And of course, any sort of financial instrument where there's a element of structuring or risk, futures, options, et cetera, you're typically going to be able to price higher than you would on, just buying a simple share or buying a, slice of Bitcoin or whatever it is. And so to me, it's a little bit of business future proofing and revenue diversification, which isn't too surprising given the scale that some of these exchanges have reached.
Yeah, I definitely think there's this blurring of the lines between, crypto platforms that have reached scale and these fiat platforms for sure. And I think we're probably seeing that even in some of the payments side, that, where you're seeing, traditional digital wallets, remittance apps that were built on Web2 infrastructure looking over the fence at, you mentioned Sling earlier, at remittance companies like Sling popping up, maybe compete against Wise. So you're seeing it on both sides, not just in the investment platform space, but in the remittance app and the digital wallets. So I think these worlds are slowly, definitely, coming together. And then, and that's really kind of some of the infrastructure that we've built is really to create this interoperability between that, fiat world, at least for some of the payment apps, and the crypto world, and really make them one platform, so to speak. So, yeah, I think, you're going to increasingly see more M&A in the space for sure.
Yeah, I think with more regulatory clarity, we should expect to some extent there'll be more consolidation. And I think it's very hard in an environment where you don't know if crypto's going to be legal or what you could do or what the rules, to make significant investments in M&A in terms of scaling companies. I think now, yes, there's still questions on crypto market structure, and we'll see what happens with Genius Act. But I think that many companies have more of a business case internally to start to take action, rather than you had to really be wait and see when there's just it's very unclear what the industry will look like and what the rules will be, which was kind of the period about a year ago.
Yeah, it's definitely interesting times. Well, my bet is we see a lot more before we see an end to it. There's certainly a lot to come. I would certainly, if I was a large global payments company or a large fintech company, be looking at this space. But very quickly, those companies in the stablecoin space are going to get very unaffordable if the demand keeps going anywhere near this trend, which seems to be counter-cyclical to the crypto market and price, which is possibly the most fascinating thing, that stablecoin volume continues to grow. Now it's found product market fit with its first use cases, and may find more when the Genius Act comes. Well, that I think is a nice place to leave today's episode. So I want to thank you all so much for listening, watching, however you consume us, whether it's YouTube or a podcast. Chris, I want to thank you for joining us as our second ever returning guest. Where can people find out more about you and BVNK?
So you can find me on LinkedIn at just Chris Harmse. That's how you pronounce the name for the third time when I come back on for the third time, and then at just BVNK.
I'm such a bad human being.
Well, get it right the third time, Simon.
Get it right the third time.
You should just start calling it like Simon or something.
Yeah, you should do it. You can totally haze me back. I'm absolutely fair game. Nabil, I've got to say, quality performance as a first timer. I think we may have to invite you back. Where do people find you in the interim?
Yeah, LinkedIn is the best place. Nabil Manji, and then you can also check out Worldpay at worldpay.com.
And Cuy?
On X at Cuy Sheffield and visa.com/crypto.
You'll find me at sardine.ai, fintechbrainfood.com, or searching for Simon Taylor on LinkedIn. If you haven't already, please subscribe. If you're watching, hit that like button. It really, really helps us. And tell your friends to subscribe too. We're the little podcast that can. Thank you so much, and we'll catch you next time.